Welcome to StockTok's deep dive into Capital One Financial Corp. Capital One is one of the largest consumer-facing banks and credit card issuers in the United States, competing on data-driven underwriting and mass-market credit access. At the time of recording, the stock is trading at $206.47, sitting roughly in the middle of its 52-week range, which stretches from $161.51 on the low end to $259.64 on the high end. The 50-day moving average sits at 194, while the 200-day moving average is at 214.45, meaning the stock is trading above its short-term trend, but still below its longer-term average. The 14-day RSI, a momentum indicator measuring buying and selling pressure on a 0 to 100 scale, reads 65.6, which is technically neutral but approaching elevated territory. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Capital One generates revenue primarily through interest income on credit cards, auto loans, and consumer banking products. With a technology-forward operating model, it has positioned as a differentiator against traditional lenders. The StockTok score for Capital One Financial Corp comes in at 44 out of 100, a caution signal. Breaking that down across 5 dimensions: valuation scores 6 out of 20, financial health scores 10 out of 20, profitability scores 5 out of 20, growth scores 15 out of 20, and smart money scores 8 out of 20. The headline takeaway is that growth is the clear bright spot, while valuation and profitability are areas that warrant scrutiny. Now, valuation. The question every investor has to answer: are you paying the right price? The trailing price-to-earnings ratio, how much investors are paying for every dollar of past earnings, stands at 69.75 times. That is an elevated multiple for a consumer bank, and on the surface it demands explanation. The forward price-to-earnings ratio, which prices the stock against consensus future earnings estimates, drops sharply to 10.26 times, a dramatic compression that suggests the market expects a significant recovery in earnings power ahead. The PEG ratio, which adjusts the price-to-earnings multiple for expected growth, with 1.0 considered fair, reads 1.84, indicating the stock is not cheap even when growth is factored in. The Guru Focus Value, an intrinsic value estimate derived from historical multiples and projected fundamentals, sits at $147.91 at the time of recording, implying a negative margin of safety of roughly 39.6%. Meaning the stock trades at a meaningful premium to that model's fair value. Wall Street analysts, at the time of recording, have a consensus mean target of $257 across 21 analysts, ranging from a low of 213 to a high of 310, with the consensus recommendation sitting at buy. That analyst setup suggests the street sees upside from current levels, even if our valuation models flash caution. On the moat, in our view, Capital One's competitive advantage rests primarily on proprietary data analytics and brand recognition in mass-market credit, meaningful switching costs in auto lending and card loyalty, but not a fortress moat in the traditional banking sense. The next earnings report is due April 21st of 2026, with the street expecting earnings per share of approximately $4.63, ranging from $4.34 to $4.88. A potential near-term catalyst worth monitoring. Market sentiment around Capital One Financial Corp, as of the creation of this video, leans neutral, with insufficient recent news flow to establish a directional bias. On balance, in our view, the valuation picture is stretched on trailing metrics but more defensible on a forward basis. Moving to financial strength, how solid is the foundation? We start with the Piotrowski F-score, a 9-point checklist that evaluates a company across profitability signals, leverage trends, and operating efficiency improvements, with scores of 7 or above considered strong and scores of 3 or below considered distressed. Capital One scores 6 out of 9, which places it in solid but not exceptional territory. The Altman Z-score, a multivariate model originally designed to predict bankruptcy risk, where scores above 2.9 suggest safety and scores below 1.8 signal distress. Reads 0.00. This is an important nuance. The Altman Z-score is structurally unreliable for financial institutions, which carry debt as a core operating input rather than a financial liability, so that reading should not be interpreted as genuine distress. It is simply a model limitation for banks. Turning to leverage, the debt-to-equity ratio, total debt relative to shareholder equity, is 0.44, which is moderate by credit card issuer standards. The cash-to-debt ratio reads 1.14, meaning the company holds slightly more cash than total debt on an absolute basis, a reassuring liquidity signal. Interest coverage data is not available, which is common for banks where interest expense is a core business cost rather than an overhead item. In our view, the balance sheet is not alarming, but it is not fortress grade either. Appropriate caution is warranted. Next up, profitability. Is this business actually making money efficiently? We begin with return on invested capital, a measure of how effectively the company converts capital into profit, where higher is better and double-digit readings are generally considered strong. For Capital One, the data does not surface a clean return on invested capital reading, which is again a structural feature of financial institutions, where capital is both the input and the output of the business model. Gross margin and operating margin figures similarly do not translate cleanly for banks in the traditional sense, so we set those aside. Where the data does speak clearly is on net margin and free cash flow margin. Net margin, the share of revenue that survives all costs and reaches the bottom line, is 4.59%. That is modest in absolute terms, though for a consumer credit issuer operating in a high credit loss environment, it requires the context of credit cycle positioning. The standout figure here is the free cash flow margin of 48.92%. Free cash flow, the cash a business generates after capital expenditures, at nearly 49% of revenue, is a genuinely strong signal, indicating the underlying cash generation engine is functioning well even if reported earnings are temporarily compressed. Return on equity, which measures profitability relative to shareholder equity, reads 2.65%, and return on assets comes in at 0.41%, both subdued readings that point to a profitability profile that is currently running below historical norms. In our view, the free cash flow margin is the most credible signal in this section, and it argues that the business is not broken, it is cyclically pressured. Onto growth. Is this business expanding, and at what rate? Over the trailing 3 years, Capital One has grown revenue at 16%. That is a strong compounded rate for a financial institution of this scale, suggesting the company has meaningfully expanded its earning asset base and successfully grown its card and auto loan portfolios through a challenging rate environment. Stepping back to the trailing 5-year window, revenue growth averages 10.8% annually, still comfortably above the low single-digit growth rates you would typically expect from a mature commercial bank. The deceleration from the 5-year to the 3-year average moving in reverse, meaning the 3-year rate is actually higher than the 5-year, tells us growth has been accelerating in the more recent period rather than fading, which is a constructive signal. Book value per share growth over the trailing 3 years comes in at 9.6% annually. Book value growth, the expansion of net assets attributable to shareholders, is particularly meaningful for financial institutions because it represents the organic capital-generating capacity of the franchise. A near double-digit book value growth rate for a bank is a credible demonstration of retained earnings compounding. On the income side, Capital One pays a dividend with a current yield of 1.36% at the time of recording. That yield is modest, positioning the stock as a growth and reinvestment story rather than an income vehicle. The dividend yield is not a primary investment case here, but its existence signals management's confidence in sustained cash generation. In our view, the growth dimension is the strongest pillar in this analysis, and the 15 out of 20 score it receives in the StockTok framework reflects that honestly. Now let's talk smart money. What institutional capital is actually doing with this name? Capital One Financial Corp is held by 30 top-tier institutional investors, what we call gurus, tracked through 13F regulatory filings, which are quarterly disclosures that funds managing over $100 million in assets must submit to regulators. Three names stand out at the top of that list. Christopher Davis of Davis Advisors carries Capital One as 9.38% of his portfolio, a significant concentration bet, and has been adding to that position, increasing by 2.8% in the most recent filing. Glenn Greenberg of Brave Warrior Advisors holds the stock at 5.73% of portfolio and has also been adding, up 4.57%. These are high-conviction investors with long holding horizons, and their continued accumulation is a meaningful signal. On the other side of the ledger, Clifford Sossin of CAS Investment Partners, at 6.06% of portfolio, has been reducing by 12.22%, a notable trim that warrants attention, as Sossin runs a concentrated deep value book. Looking at the broader institutional landscape, only 12.5% of 13F filers are net buyers of Capital One at the time of recording, a reading well below the 50% threshold we typically associate with net bullish institutional sentiment. Insider ownership sits at 1.24%. That is low, suggesting executives hold relatively little of their own stock. Most pointedly, insider transactions over the trailing 3 months show 0 buys and 10 sales. Insiders selling while the stock trades at a discount to its long-term average is a signal we note, not proof of negative thesis, but worth weighing against the guru conviction on display from Davis and Greenberg. In our view, the smart money picture is divided. High-conviction long-term holders are adding, but the broader institutional tide and insider activity lean cautious. And finally, the verdict. Let's bring it all together. On valuation, the trailing multiple is expensive at nearly 70 times earnings. The Guru Focus intrinsic value model suggests a meaningful premium to fair value, and the PEG ratio of 1.84 does not offer the margin of safety, meaning the buffer between price and intrinsic value that a disciplined buyer would want, though the forward multiple of just over 10 times is genuinely compelling if earnings recovery materializes as the street expects. On financial strength, the Piotrowski score of 6 and a cash-to-debt ratio above 1.1 are reassuring, while the Altman Z-score caveat for banks reminds us to read balance sheet signals with sector-specific judgment. On profitability, the near 49% free cash flow margin is the standout positive, but subdued return on equity and return on assets suggest the profitability engine is running below capacity, likely cyclically rather than structurally. In our view, on growth, 16% revenue growth over the trailing 3 years and near double-digit book value compounding are genuine strengths, and in our view represent the most compelling argument for the bull case. On smart money, high-conviction holders like Christopher Davis and Glenn Greenberg are adding, but broader institutional buying is thin at 12.5%. And 10 insider sales with 0 buys in 3 months warrants honest acknowledgement. The overall setup, in our view, is one of a well-run franchise at a price that already prices in significant optimism. The thesis depends heavily on earnings recovery and credit cycle normalization playing out as expected. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Capital One Financial Corp. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.